Okay, picture this. Your company gets hit with a massive lawsuit. You haven't actually lost it yet, but, well, things aren't looking great. The final verdict, that could be months, maybe even years away. And the final payout could literally be anywhere from a few thousand to millions of dollars. So how on earth do you put that on a balance sheet today? If you're an investor, this is exactly the kind of hidden financial landmine you want to know about, right? It's kind of the ultimate accountant's dilemma, trying to officially record an expense when you don't know exactly when it's going to happen or precisely how much it's going to cost. Welcome to today's Explainer. We're going to explore exactly how the accounting world deals with these massive question marks, using Accounting Standard 29, or AS29 for short. Think of this standard as a magical sword, specifically designed to help accountants slay the beast of financial unpredictability. It gives them a strict, clear framework to navigate the murky waters of the unknown, ensuring businesses don't totally blindside their investors.
Okay, let's dive into our roadmap. We'll be looking at navigating financial uncertainty, defining the big three, the recognition test, measurement and review, special accounting scenarios, and finally, the AS29 decision matrix.
Part 1. Navigating Financial Uncertainty, otherwise known as the Accountant's Dilemma. Part 2. Defining the Big Three, the core cast of AS29.
So the whole objective of AS29 is basically zero nasty surprises when it comes time for financial reporting. But to get there, we need to meet the main characters. Let's start with the big one, a provision. By definition, a provision is a liability of uncertain timing or amount. Think about recalling 1,000 exploding phone batteries, or maybe the future cost of cleaning up a toxic mining site. A provision is a present obligation that stems from a past event, and crucially, we fully expect an outflow of economic benefits to settle it. We just don't know the exact dollar amount or the specific day the check needs to be written.
Next up, we have the contingent liability, and notice the emphasis here on the word possible. This is a possible obligation that depends entirely on uncertain future events that are totally outside the company's control. Or it could actually be a present obligation, but one that accountants don't officially recognize on the books just yet, either because an outflow of resources isn't actually probable or they just can't measure it reliably. As an investor or an employee, you absolutely want to know these exist, even if they haven't crossed that threshold of certainty that hit the official balance sheet.
Finally, let's look at the contingent asset. This is the flip side of the coin. It's a potential win for the company. It's a possible asset arising from past events, but just like its liability cousin, its actual existence depends on uncertain future events. It's a potential windfall hanging in the balance. But, accountants are professional pessimists, right? They will not let a company celebrate a win or record this asset until the check actually clears.
Part 3. The recognition test, or the ultimate checklist.
So knowing the definitions is great, but how do accountants actually decide when to put these numbers into the official records? Notice how AS29 defines an obligating event. You don't always need a signed piece of paper to be on the hook. Sure, you've got your standard legal obligations, things arising directly from a law, a contract, or legislation. But AS29 also tells accountants to look out for constructive obligations. These arise simply from your company's established practices, published policies, or specific public statements. Basically, if your past behavior creates a valid expectation among others that you're going to take on responsibility, guess what? You've got yourself an obligation.
To officially recognize a provision on the books, an accountant has to walk through this mandatory 4-step diagnostic tool. Step 1, is there a present obligation? Step 2, did it arise from a past event? Step 3, is there a probable outflow of resources to settle it? And Step 4, can a reliable estimate be made? Here is the absolute kicker. If even one of these steps fails, literally just one, no provision is recognized. It's a strict all-or-nothing test. Part 4. Measurement and review. Hitting the moving target.
Okay, let's say you actually pass the recognition test. Awesome. But how do you put a firm price tag on something that is literally defined by its uncertainty? Well, accountants have to calculate the best estimate of the expenditure required to settle the obligation at the reporting date. And to do this, they have to weigh 3 really critical variables. They got to factor in inherent risks, they have to consider future events with objective evidence, and finally, account for the time value of money. Because, let's be real, paying $1 million today hurts a whole lot more than paying it 10 years from now. So if that gap is massive, they discount the provision to its present value.
And the work definitely doesn't stop once the number is on the page. AS29 explicitly mandates that this is never a set-it-and-forget-it kind of deal. You have to review provisions at every single reporting date, because as time passes, better estimates might become available, which means you have to make adjustments. And hey, if the situation changes so much that an outflow of resources is no longer probable, you have to reverse the provision entirely.
Part 5. Special Accounting Scenarios. Navigating the Exceptions.
Business reality is rarely straightforward, right? So AS29 acts as a really strict guide for accountants navigating some tricky situations. Two common ones involve reimbursements and operating losses. If a company expects another party to reimburse them, say through an insurance claim, you can only recognize that reimbursement if it's virtually certain to happen. You absolutely cannot claim an insurance payout you just merely hope you'll get. On the flip side, you can never ever create a provision just because you think you're going to lose money next year. Future operating losses simply do not satisfy the definition of a present obligation from a past event.
Then we have onerous contracts. This is a situation where the unavoidable costs of meeting your obligations under a contract actually exceed the expected economic benefits you'll get from it. Think of being locked into a 10-year lease for a warehouse that you've completely abandoned. You are mathematically guaranteed to lose money there. When costs exceed benefits like this, AS29 requires accountants to immediately recognize a provision for that unavoidable loss.
Restructuring is another massive one. If a company is reorganizing, they can't just broadly squirrel away money for some vague future plan. AS29 requires two very strict things for a restructuring provision. A detailed, formal plan has to exist, and a valid expectation must have been created among the affected parties. Crucially, you can't use a restructuring provision as a slush fund to hide future losses, staff training, or marketing expenses. It is strictly for the direct, unavoidable costs of the restructuring itself.
Part 6. The AS29 Decision Matrix, your master cheat sheet.
We've covered a lot of dense ground today, so let's synthesize it all. This is essentially the climax of our explainer, the ultimate logic matrix for liabilities. Let's break it down. If you have a present obligation, a probable outflow, and a reliable estimate, you officially record a provision. Boom. But if it drops down a tier to a merely possible obligation, it becomes a contingent liability. You don't put the number on the balance sheet, but you must disclose it in the footnotes. And finally, if the chance of an outflow is remote, meaning it's highly unlikely, you do absolutely nothing. No recognition, no disclosure. Just move on.
Now let's quickly flip over to the asset side of things. And this brilliantly illustrates just how conservative AS29 really is. You have a possible asset? Zero recognition. Do not count your chickens before they hatch. Even if an inflow of economic benefits is probable, you still only disclose it in the notes. You don't record it as a hard asset. It's only when the realization of income becomes virtually certain that accountants are finally allowed to recognize the asset on the books.
So AS29 is basically an absolutely essential survival guide for accountants trying to enforce transparency in a chaotic world. But it leaves us with a pretty fascinating question to ponder. As business moves faster and as global markets get more volatile and complex, is true financial predictability going to become a thing of the past? And if so, how much harder is the accountant's job going to get in the future? Thank you so much for joining me for this explainer. Keep asking questions, and I'll see you next time.